Let's bring in our FOMC roundtable from Berkeley, California. We're joined by Christina Romer, President Obama's former chief economist and now an economics professor at Cal Berkeley. And from here in New York, Ethan Harris, head of developed markets economics research at Bank of America Merrill Lynch. Ethan is ranked as one of the most accurate forecasters by Bloomberg, making him a Bloomberg best. Thank you both. Professor Romer, let's begin with you. What's your initial reaction to what our Michael McKee was telling us about the Fed minutes?
Well, I think certainly the fact that there was widespread agreement that economic conditions had deteriorated, I think that was something that everybody had seen, but it's good to know that was first and foremost in the FOMC members' minds. I think one of the things that wasn't clear to me from what Michael said is just how strong the feelings were on sort of the side for more easing. We know that there were 3 dissents against the action, and I'd be interested to know, given, for example, what Charlie Evans said today, how strong were the voices saying we should in fact be doing something much stronger than, say, extending the time period over which the funds rate would be kept lower.
Ethan Harris, your remarks?
Well, I agree. I think that there actually is probably a equally strong view among the doves in the committee that more action should be taken. They didn't feel that strong that they actually dissented. They could have dissented and said we should be doing more instead of just this very small step. But I do think in the coming weeks we're going to hear a lot from FOMC officials. They're going to play out this debate in public. Charlie Evans, I'm sure, isn't going to be the last person to come out and suggest a more aggressive policy from the Fed. So I think there's a tendency for people to listen to the hawks because they're the most vocal. But I think within the FOMC, there's a pretty big group of doves who think, given the state of the economy, they should be doing more.
We'll talk about that coming up in just a moment. Ethan, data released today by the Conference Board was showing that worries about the economy are lowering consumers' confidence, which is now at its lowest level in more than 2 years. Is it time, as some have been saying, for the Fed to take a more accommodative approach? And we should point out that the decline in consumer sentiment was evident even before S&P's downgrade of U.S. debt.
Well, I think that the Fed should pretty much continue what they're doing, which is taking smaller steps just to kind of confirm to the marketplace and to consumers and businesses that they're still there and they're still trying to revive growth. I don't think they want to go to QE3 unless they really think we're sliding towards a recession. The problem with doing QE is that it creates so much controversy, so much negative publicity, I think unwarranted negative publicity, that to some degree it actually undercuts confidence about policy in the economy. So I think they're right to adopt a more measured approach and only go to the QE3 if this confidence reading shows up in hard data, which, that show equal weakness.
Dr. Romer, I wanted to give you a chance. I posed that question to Ethan Harris. Time now for a sense of a stronger accommodative approach from the Fed. And we should mention that at that August 9th meeting, some policymakers did seek a stronger approach.
I do think that is what's called for. I feel a lot of agreement with Ethan when he was saying maybe QE3 is not the right answer. Certainly not a sort of one-off, another set of asset purchases. What I'd be interested is to see if the Fed may start talking about a more dramatic change in its whole operating procedure, moving to something like a price level target, something that Charlie Evans at the Chicago Fed gave a very persuasive speech might be a good way forward. That sort of new, more dramatic change in the framework might imply more asset purchases, might imply lower interest rates for a longer period of time, but also might give markets certainty of what's the framework, what's the thought process that's going to be driving the Fed going forward.
Dr. Romer, in a question and answer session following a speech today in North Dakota, the Minneapolis Fed President Narayana Kocherlakota said that the fundamentals in the U.S. are strong and that the Fed has, in his words, a range of policy options for the future. If those fundamentals are strong, why is consumer confidence so low? And as far as policy options are concerned, what might those options be?
So I'm not sure what data President Kocherlakota is looking at to say fundamentals are strong. I mean, of course, the the educated labor force and our, innovative edge, all of those are still good. But this is still a deeply, deeply troubled economy. And, if you look at forecasts for growth in the second half of this year, they're 2% or lower, right? That's something that's going to tend to raise the unemployment rate, not bring it down. So, absolutely, this is an economy that needs help. And the question is whether we'll get it on the fiscal side or what the Fed might do. And as I said, I think the Fed may need to be thinking about more dramatic, more fundamental changes in its operating procedures.
Ethan Harris, how much help does this economy need right now?
I certainly agree. I mean, in the very long run, we may be in great shape, but right now the economy's in rehab. I mean, we are struggling. I think that it's dangerous for the hawks and the FOMC to come out and say we're out of ammunition, we can't do anything, because we still have a long way to go. We have a 9% unemployment rate. This has been a terrible recovery from a very deep recession. I hope that Washington, both on the monetary and fiscal side, has some ammunition they're ready to use. Sitting back and just keeping your fingers crossed, I think, is a dangerous policy.
Ethan, our economics editor Michael McKee made an interesting observation today. He said that here in the United States there is, quote, recession-era confidence. What does the nation need to hear from President Obama when he delivers his speech on jobs next week?
There's no magic bullet for him. I think if he can get some kind of at least small fiscal plan through, perhaps extend the payroll tax cut, some other kind of jobs-oriented things, that might help a little bit. What I think the main thing that Washington could do right now, frankly, is to be less dysfunctional and stop having crazy fights and threatening to default on the debt and other things like that. Proactive policy is going to be very hard to get in Washington, but at least stop doing bad things and at least give some confidence to people that in their government.
Dr. Romer, Ethan Harris telling us politicians do no harm. You've been in the middle of all of that craziness in Washington. What does the president need to tell the nation next week?
I certainly hope that the president comes out much stronger than what Ethan was describing. I think, I agree that the chance of getting a bold fiscal stimulus and a bolder deficit reduction plan is small, but I think that's what the president has to call for. I think he has to give people his vision of what the fiscal side of the economy should look like. And I think it should be some very aggressive short-run help for the economy, tied in with much more significant deficit reduction than was passed in the debt ceiling debate. I think he should go from there to say, and if you don't pass those, I'm prepared to, to do these various executive actions, or, at least let's do these smaller things. But I think he does need to give people the vision of what he thinks is right and try to convince the American people to go along with that.
Dr. Christina Romer, professor of economics at Cal Berkeley and a Bloomberg contributing columnist, and Ethan Harris joining us from here in New York. Thank you both so much. Appreciate it.
Thank you.